All right, so learning objective 2 gives more detail on accounts receivable. One of the first things that we realize is accounts receivable is an asset, and so it's going to be on the balance sheet. And one of the basic principles of generally accepted accounting principles is we have to be conservative in how we value our assets. Okay. Actually, we have to be conservative how we value our liabilities as well. But in this case, accounts receivable, just because you're owed $100,000 doesn't mean you should put that down on their balance sheet as $100,000 because then you're certainly overstating it. So there's got to be a way to adjust the value of the account. And that's what we're going to be learning about in this chapter. It's going to be fabulous. Well, why do we have to adjust things? Well, because some accounts are simply uncollectible. All right. Not every customer is going to be able to pay. Um, and that's a sad reality. It's a risk that you take. Okay. And of course, you're expecting that cash because you made a sale on account. So you actually did the work, or you gave them the product. And of course, it's a business to business relationship. You're trusting that they're going to pay you. But as you know, sometimes businesses go out of business. Sometimes businesses have financial problems and they cannot pay you. So, what does that mean? Well, that means that some of these receivables end up as something called a bad debt expense for a company. Okay. And that's a new expense account that you're learning about now, but that's also the reality of what happens to some receivables. Okay. Unfortunately, it's not as easy as it seems for corporations because of the reporting standards that GAAP requires. But for other companies, they're missing an F here. Other companies that do not or are not subject to GAAP can simply use what's called a direct write-off method, right? Which means as soon as they've identified a bad account, they can simply write it off that day as a bad debt expense. And that clears up that receivable, takes it out of your receivables because you don't want it there. It's not going to turn into cash. It's bad, so you can expense it. Um, but you can only use this particular method if you're not subject to the rules of GAAP and financial reporting. So if you're a sole proprietorship, if you're a partnership, or even if you're a private corporation, technically you can use direct write-off anytime. For public corporations that have these financial reporting rules that they have to go by, or we call GAAP, right? They have to use a method called the allowance method. And as you'll see, the allowance method only allows them, no pun intended on the word, only allows them to have a bad debt expense at the end of every fiscal period. Okay. Which means that how do they know? Well, they have to estimate. They have to estimate what their bad debt's going to be. And so that's what we're going to be talking about the most in this chapter. Mhm. I'm not going to go through this. I will go through how it looks on the balance sheet. So for a lot of balance sheets, when you look at accounts receivable, you'll be surprised to understand that it looks a little bit like equipment, for example, because remember equipment. As soon as you see equipment, there's that accumulated depreciation for equipment right underneath it, right? Well, there is a contra asset account that goes underneath accounts receivable because we have to, in essence, estimate what our bad debt is ahead of time. So that money has to go into the allowance for doubtful accounts. This is a real account. It sounds interesting. Like no one would ever, I'm used to accounts payable or cash and equipment. No one would ever name an account allowance for doubtful accounts. Well, they did. But that's an actual name of the account. It's an actual asset account, but it's a contra asset, just like accumulated depreciation is a contra asset. Accumulated depreciation is always going to be underneath equipment, It's going to be underneath buildings, right? Because it's subtracted out. Same thing with the allowance account. It's going to be right underneath your accounts receivable. You're always going to have this account piggyback together. And this is where we put the money into this particular account for that future identification of a bad debt. Because GAAP only allows us to do this one time a year. So as you'll see how it's practiced. What does that do? Well, it actually corrects that problem on the balance sheet. This $475 is going to be reported as the value of receivables, even though receivables are $500. Well, because they have allowed for a bad debt, in essence, they have adjusted the net value of their receivables, and that's what that is called. Actually, the net realizable value is here. Okay, so you'll see this often, but how you'll see it is going to be this alternative presentation is the most common way I've seen it on balance sheets in corporate America. You will see accounts receivable net of allowance. Okay, they'll tell you how much they have put aside as bad debt. And of course, this is the net realizable value that's going to be added with all the other assets on their balance sheet. But they have to have some type of allowance. They have to put something aside to show that they're not going to collect all of it. Okay, so let's go to how this looks here. So in a direct write-off method, which we can't use in public accounting for corporations, but again, any other business can do. Let's just say that Warden Company identifies this account, M.E. Doran, and they're waiting to receive $200 on this account, and it's just not collectible. And they've made this determination on December the 12th. What do? Well, they can simply write it off as a bad expense. Okay, and that's how simple it is. As they've identified uncollectible accounts, they will expense it at that time, and they're simply cleaning up their receivables. If they're not, why should this $200 still be in the receivable if they're not going to receive it? Got to get it off the books. And this is how they do it with the direct write-off method. However, there's no matching. However, corporations need to use, public corporations need to use something called the allowance method, okay, which creates that allowance for doubtful accounts, by the way. Other businesses don't have that. Other businesses don't have the allowance for doubtful accounts, but public corporations do. So the first thing they have to do is at the end of a fiscal year, they estimate how much of their receivable is likely to be uncollected. There's two methods that they use to do this that you're going to learn about in another slide or two. And they're both practical in how they are approached. Okay. But again, if they're a public corporation, they've been around for a little while. They know from their history of having receivables how much they haven't collected. So, so they'll have a couple of methods in mind already. Okay. At the end of that year, again, they're allowed to do this. They are allowed to make an adjusting entry for a bad debt expense. So they can expense their estimate of bad debts. Then they put that money into the allowance for doubtful accounts, right, which is a contra asset account that you just saw on the balance sheet earlier. Then as the year goes on, as they identify accounts that are not collectible, they take the money out of the allowance account and they credit the receivable of the person or business that's not going to pay. And that's how they clean up their books. And you'll see how this process is here. So here is a company a furniture company, Hampson Furniture. And they have credit sales of $1.2 million in the year 2017. I want to point out a term here that you might not know about. Credit sales is a nice little term. It simply means a sale on account. That's it. That's all it means, a sale on account. So credit sales and sales on account they mean the same thing. You sold something on account. It's a credit sale. So this furniture company made quite a lot of credit sales in 2017, $1.2 million of credit sales. Okay. Now, certainly they've been doing this all 12 months, so it's not like they're waiting for all 1.2 million. They've been collecting that money as they go. However, 200,000 of that remains uncollected, which means the $200,000 is their accounts receivable. Okay. It is now December 31st at the end of their fiscal year, and it's time to do this process of estimating their bad debt. Now here it's not the greatest example because they don't actually tell you, but the credit manager basically says $12,000 of this $200,000 is going to prove uncollectible. Now it's quite possible he could have used a percentage, okay, which is a very reasonable thing to do. A percentage of your receivables as uncollectible is a method you can use. So what does that mean on December 31st? Well, that means on December 31st, they're going to have that bad debt expense, so they can have their expenses recorded for that year. And they're going to put that $12,000 in the allowance account. And this allowance account is going to be carried forth through the year, okay, on their balance sheet. Remember, bad debt expense, income statement. Income statement accounts close every year. Balance sheet accounts never close. Right? So their balance sheet will look like this, right? They'll see that they will list that they have $200,000 of receivables on their books. They'll also list that they have an allowance of $12,000, which means the net realizable value, the actual value they are putting on their receivables is 188, which is very reasonable here. Okay. So what happens later in the year? So here they did that on December 31st, 2017. About 3 months go by and it's March, and they've identified a $500 balance by a client that they want to write off. Okay. Notice the client's name. So I think that this company, they are aware that this $500 is never going to happen. Get it? They are aware. Okay. But obviously he is not aware. This guy is, God knows where he is. All right. So how would they then do the journal entry to write this thing off? Well, this $500 is in their receivable. To take the receivable out, that's where they grab the money from. They grab the money from the allowance account to close his receivable. So they will debit the allowance for doubtful accounts, the $500, that's where they're taking the $500 from, to close R.A. Ware's receivable on their books. Okay. That's where they get the money. So the allowance method doesn't allow for you to just, right? If this was not a corporation, we'd have a bad debt expense, right? But because corporations are required to use the allowance method, that allowance account becomes that pot of money that they pull from when they've identified a bad debt later in the year. Okay, and that's all you're seeing right here. So what does this mean? Well, that when it's posted, you'll see the $500 coming out of the allowance account and that $500 is being applied to lower the receivable account. Okay. The net effect is zero because you got $199,500 of receivables, and now you have $11,500 of allowance. The difference is still $188,000, like was on the balance sheet. Okay, so there's no difference. That's really the great thing about the allowance account. It's you don't have to identify things as they go. It doesn't allow for appropriate matching and corrections as you go. Okay. Well, sure enough, R.A. Ware, it's July now. He's back in business and he wants to pay his bill. So he comes forth, $500 in hand, and he goes to Hampson Furniture and says, "Look, I want to pay my account." Well, one thing you're not going to do is tell this guy, "Well, look, we wrote you off, go away." No, no. He's got the cash in hand. You're staring at 5 crisp Benjamins. Okay. You're not going to let that go. All right. So what you do is say, "Okay, thank you. We will gladly take your $500. He doesn't have to know he was written off. So what you have to do is reestablish his account, put him back in the receivable, and put that $500 back in the allowance for some other, deadbeat schmuck that comes along, right? And then, of course, do what you were supposed to do in the first place. Accounts receivable is supposed to turn to cash. That's what you were waiting for. That's what you were waiting to receive, was cash. So grab the cash, send Mr. R.A. Ware, out the door. You have his 5 Benjamins, and you're happy as I don't know what, as an accountant with a lot of green. All right, so let's go back to the end of the year where they have to estimate the allowance. There's 2 methods that are used. One of them is a very simple method called a percentage of receivables, and it's just that. 3% of receivables, 5% of receivables, 8% of whatever their history has been. They can use that percentage as a basis to estimate their bad debt and create their allowance account. That's it. That's the easiest thing that they can do. A more accurate way takes a little bit more time. It's called an aging, which is what I've been doing in front of you all year. But the aging of receivables is actually quite a very good thing to know about. Because it lists all the customers, right? So each of these are individual customers and all the others. And it lists how much money each of these customers has in their receivable, what we're waiting to receive from the customers, okay? The total amount of receivables for this particular company is $39,600. That's the total, okay? Of which TEA Dirt owes 600 of, Bortz owes 300 of, etc. Okay. Well, the way receivables are, you're making a sale on account or you're doing a service on account, and you give them a bill to pay, right? So in many cases, receivables may not be due yet. And so in this case, 27,000 of that 39,000, the due date hasn't hit yet. We're still waiting. It's still within that 30 days, period that you're waiting to collect. So it's not due yet. You're not worried about it. So you say, look, we think that only about 2% of these newest receivables will end up being uncollected in the very end, which means $540 of the 27,000 is going to end up as our bad debt. That's our estimate. We're estimating. Now you get to the next column here, and in the next few columns, these are accounts that are past due, which means the due date has come and gone, and you haven't received it yet. The first column shows that they've missed their due date between 1 and 30 days. So it could have been they owed you money yesterday, and today is their first day that they're past due, or it could have been 30 days ago. But as you see, $5,700 of the 39,000 is in this late category, 1 to 30 days. Now, just because someone's a little bit late, life is busy. People get doing all types of things. And, they might miss a deadline or two. I mean, it's happened to almost everybody. No big deal. So, yeah, chances are you're going to collect most of that. But in this case here, we think that now about 4% of those are probably going to be, gone. We're never going to see, which means $228 of the $5,700 we believe will end up as bad debt. Let's keep going. The next column, you're 1 month to 2 months late. Okay, not good. Thankfully, it's only $3,000 of the 39,000. That's 1 to 2 months late. Well, because you waiting, in essence, the longer you wait, that's the aging piece. The longer you wait, the less likely you're going to see the money, right? So look at this. They estimate that 10% of this will never be seen. So look how it's jumped from 2% to 10% already, right? And so that gives us a very interesting a viewpoint here. Now the next column, this is 2 to 3 months late. It's like I've been waiting by the phone, and it's been 2 or 3 months. I haven't eaten in 2 to 3 months, waiting for your call on the phone there, but nothing. 2,000. Thankfully, it's only a small piece of change. $2,000 of the $39,600 is 2 to 3 months late. But now we think that 20% of this we're never going to see, which is the $400, 20% of 2,000. And then here, over 90 days, I mean, forget it, we're thinking almost half of this thing is not going to be ever seen. Okay. And so that's our estimate. Notice that as time, right, as the age of the account has increased, so has our estimate for uncollectible. Whereas the percentage of receivable method, the first method I showed you, has 1% for everything. Right? Here they break it by age to show you, hey, look, this is what we really think. The longer we're waiting for the money, just the more we're not going to collect. So all of these numbers combined is what the $2,228 number is. So it's all these bottom numbers added up. So this basically, this 2228 number here is the allowance. That's what they want their allowance to be, because that's how they've estimated it. Okay. So let's continue on that. Remember, the allowance is $2,228. That's what they want to have that be. So now we're at the end of the year. It's December 31st. We've just done an aging of our accounts, and we want the balance to be $2,228. Okay, that's what we want our. So let me set up a little allowance for doubtful accounts, the ADA here. We want our balance to be $2,228. That's basically what we just did. We've calculated what our balance is. However, when we look at the account, there's already $528 in it on the credit side. Okay. What can we write off on December 31st? Well, you could only write off the difference. Okay. If this is what you calculated on the aging is what you want in your allowance account. And so, because it's not your first year in business, you've been doing this for a while, there's probably a balance in the account already. You just calculated what you want the balance to be. So you simply can adjust for the difference. So in this case, the bad debt expense for this year is going to be $1,700, because if you adjust your allowance account by $1,700, you'll get that 2228. As a matter of fact, it looks a lot better down here than my little chicken scratch here. Matter of fact, that's maybe an insult to the chicken. So here is the posting of the $1,700 bad debt expense for the year. And here is what I was trying to do up there. If it already has, again, the allowance account already exists. We already have decided through our aging process what we want the balance to be. Whatever's in there, just adjust it. Fascinating. Fascinating. Okay, so that brings us all the way to our bad debt expense do it exercise. Brule Company has been in business 5 years, so they have a record here. They show the following data on their trial balance. Their receivables have a $30,000 debit balance. Sales revenue is $180,000. That's really nice. We don't really care. Allowance for doubtful accounts has a balance, but it's a debit side balance. So this is weird. This is really weird. Again, here's our ADA account here. Sorry. And it's got a $2,000 debit side balance on this. Interesting. What do we want our balance to be? Well, bad debts are 10% of receivables. So 10% of receivables is 3,000. So we basically want the allowance account to have a $3,000 credit balance, right? Because allowance for doubtful account, contra asset, credit side balance. So all you're doing to figure this out is how do we get to a $3,000 credit balance from where we are here? And the answer is you need to adjust it by 5,000. So that's going to be our bad debt for the year, $5,000 bad debt expense. And the allowance for doubtful accounts will have a $5,000 credit. If you put the $5,000 credit here, you'll see the credit side is bigger by 3,000, which is what we want. Fascinating. Fascinating. Two more quick things on this objective. Businesses can sell their receivables for cash. Okay. This is not always the case, but sometimes businesses need to grab cash, and certainly they might look at their line of credit at a bank, but sometimes you just need more money. So you can sell your receivables to a company called a factor. And a factor is either, it's a finance company or a bank that specializes in collecting receivables. So they buy these receivables from businesses at a discount. They charge a commission, which means they're not paying full value for the receivable. In other words, the company that's selling the receivable is also not receiving full value for selling them because they have to pay this fee. So basically speaking, they must really need the cash to do this, I would say. So here we have another furniture company. They factor off $600,000 of receivables to a company called Federal Factors. Federal Factors has a 2% service charge, okay, which means that they're charging $12,000 to buy the $600,000 of receivables from this furniture company. So what's the entry look like? Well, the furniture company is only going to get $588,000 in cash because they had to pay a $12,000 service charge, which they expense. But they will say goodbye to $600,000 of receivables. Okay. But again, it didn't turn into the same amount of cash because they needed it right away. So whenever you need to borrow money or need money right away, you're going to have to give up something. The second thing too is this confusion about credit cards. All right. Now, most retailers are members of the networks, such as MasterCard or Visa or Discover American Express, and there's a bunch of them out there, right? They're part of a network. They have agreed as part of the network to accept the cards there, and they've agreed to pay a fee to become part of the network. Okay. So when a customer walks in and buys something with a credit card, the merchandiser is actually getting cash forwarded to them. So it's a cash sale. They're not getting the full value of what they sold because they have to pay the fee. Okay. There's a lot of advantages as to why retailers want to do this, because if retailers gave everybody an accounts receivable, they would have to do a credit investigation of every customer, maintain those accounts, undertake collection, and things like pain in the butt. Much easier to pay a fee and be part of Visa, MasterCard, etc. Okay, and they get the cash very quickly, usually within 1 to 3 days. They get the cash. Perfect. Why bother? It's a cash sale. So how it looks to a company that accepts a credit card is given here. You have a Morgan Marie buys $1,000 worth of music for her restaurant from this music company, Songeroth Music Company. She uses her Visa card. Songeroth accepts Visa and their 3% fee for being part of that network. So how does Songeroth Music put this in their books? Well, they are going to record the sale of $1,000 of music. However, because they've agreed to the 3% fee, they're going to collect $970 of cash and have a service charge expense for 30 bucks. And that is basically how they handle it. Okay. So again, anytime you have a factor involved in this case, you can sell part of your receivables. You're going to assume a service charge every time you do that. So even though you are going to get rid of some of your receivables as your do it exercise shows here, it's not going to turn into the exact amount of cash. Okay. So we'll take a quick break and see how you're doing on that.